There's a snippet from a conversation between two men in one of Ernest Hemingway's books where one asked the other, "How did you go bankrupt?" And the other guy said, "Two ways, gradually and then suddenly." These words could be used to describe some life insurance policies that have not been managed. The deterioration is painless and maybe not even noticed until one day the coverage is in place and the next day it's gone. About 5 years ago, we were asked to make a recommendation around an underfunded $600,000 policy insuring an 89-year-old. Premium payments were discontinued years ago, and the current unattractive path, considering the inadequate past funding, was dwindling cash and the likelihood of the coverage lapsing prior to the insurer's death. Frequently, the initial reaction from the policy owner is that, well, the cash is going away, so we should cut our losses and cash it in. A bird in the hand is worth two in the bush, so to speak. So we prepared a chart that illustrates two alternatives to consider going forward. Never mind the past, it's all about the future, and we must play with the cards we're holding, so to speak. And past premiums paid are sunk costs. The left side of the chart shows the result of surrendering the policy for cash, ignoring the possibility of taxable gain. So let's take it a step further and think through how much we'd have to earn in order to transform the cash value into $600,000. So if the timeline for our study is the insured's age 95, then an annual compounded 29% after tax would be needed. And obviously this is a high bar. The right side of the chart shows the premium outlay being increased from zero to around $7,000, which would maintain the policy given the assumptions to age 95. And the internal rate of return on $7,000 annually would be around 84% if death occurred at age 95. So it was advantageous to maintain the policy because of the finances. A part of this story is that the insured passed away at age 93, so actual internal rate of return was 115% annually over this time period, transforming a few $7,000 payments into the $600,000. It may seem awkward to speak in terms of rate of return connected to someone's death, but life insurance is a financial asset designed to create capital upon death. So we ask permission to take our emotional hat off and put our financial hat on, because it's all about the math with the policy. And one way to describe our collective role is that we help our clients create the future they want for those they care about. And I believe the best way to create the future is to design it and manage towards it. Thank you for listening.